Well, welcome to another video. Today I have my first guest on the channel. His name or his pseudonym is Dollar McGavin. He is a member of Baby Pips. This is how I've met him. And he just seemed very knowledgeable. I just spent more than an hour talking to him off a recording to see whether we can make a good video. And I really liked what he was sharing. And I thought, people here would really benefit from hearing his ideas and his views on trading and hopefully make you more profitable along the way. I have seen some of his accounts. I've done some little background check. Unfortunately, nowadays, there's too many scammers out there, but I reached out to Dollar McGavin. He's not growing any kind of following. He has no interest in this kind of stuff. So in my opinion, he's a good source to listen to. But what's most important is not just, that he's trading and all that. It's also what ideas is he putting forth and what can you take from those ideas to actually help in your trading. All right, so with that, let's get started. Welcome on the show, Dollar.
Oh, thank you for having me. Glad to be here.
All right, so just give us a little bit of an idea of your background. What have you done before you started trading, and how long have you been trading? How long of those years have you been profitable?
Yeah, I'm originally American, so I grew up in the U.S. Spent all of my childhood there until about I was in my early 20s. I met my first wife in Boston, and she was Swedish. So I moved to Sweden. When I was in my early 20s there. Yeah, unfortunately, the marriage didn't work out, but we have two wonderful kids together that are all grown up. So I stay basically in Europe, to be with them. And then I met my second wife, and now I have two more kids with her. So yeah, we're just adding to the litter. As far as, let's say, my background, believe it or not, I used to be a guitar player back in the U.S., a musician. I didn't really spend too much time in that industry because after I met my wife, I moved over here, and the music industry was just dead in Sweden back at that time compared to the US. So I had to find something else to do. I got into electrical engineering. So I got a master's of science degree in electrical engineering, started working in the whole mobile internet thing, and got all the what do you call it, development work and the technical, systems and stuff back then. Went into management consulting, started up a business in management consulting, which is where I am today. I did that for about 10 years. And then I saved up as much money as I could within the business. And even with management consulting, I also did some angel investing, invested in other companies, unlisted companies, and so on. And made money that way as well in the business. But then I wanted to get into trading. And so I tried to do trading, let's say, privately with my own private money, first about 15 years ago. Started off doing day trading, wasn't very good at it. I felt I was spending too much time in front of the screens. Then I went to longer and longer time frames, got into more shorter term trading. And then an interesting thing happened. I was getting some funds, into a retirement account, the sort of thing that we have here in Sweden, where you can put in a certain amount of money tax-free, every year, and you can invest it however you like, and then whatever profits you make, they're tax-free until you take them out when you retire. So this was back in 2000, I think 10, 11 or so. I just put them into tech funds. That's all I knew was technology stocks. So I threw the money into tech funds and just threw $100 every month into that account. Meanwhile, I was trying to do short-term trading, trading on my own, and after 5 years, I had blown like 3 accounts, as we all have, doing trading. But my retirement portfolio was up like 400%. I was thinking, okay, what the hell? And I barely looked at the retirement portfolio. It just grew on its own. The only time I looked at it was whenever I was putting in money, because I had to log into the interface, and tell it where to put the money, basically which fund the money should go into. But anyways, I realized that, okay, maybe short-term trading isn't really my thing. And so I started getting into longer and longer time horizons and got into, things like angel investing, and then investing into other businesses to make money that way. And that worked out fairly well. I would say we were in the ZIRP environment, zero interest rate policy. So literally everything is going up and going up in value. So it worked out fairly well.
And why didn't you stay with that then, since it was doing quite well?
Yeah, because I realized that I'm very, very dependent on the entrepreneurs, and it's really, really out of my control. So you kind of, let's say, put in 100,000, 200,000, however much you're going to put in, and then it's like up to the entrepreneurial gods, on how well the business goes, which I didn't like too much. I wanted a bit more control. Me, I tend to be a little bit more of a detail control freak, in that sense. So yeah, and it's another sort of mentality as well when you're doing angel investing. It's more like you are playing roulette, but you're betting across the board. So you may have, let's say, like 20 different ventures you're going to bet in. You're counting on maybe 2-3 of them that will survive after the first 2-3 years. And if you're lucky, maybe that one will give you 10, 20, 30x your original investment, which will cover all your other losses. And yeah, that didn't suit me very well. I did it, but I did it with a lot of other partners. And so that made it easier. But it's not something I felt like I wanted to do per se. Yeah. And then what I did was, in the meantime, I just kept doing, management consulting work, for clients and stuff, and built up a sizable treasury in the company. And once I felt like I had enough, then I wanted to go full time into trading, investing, or basically making a living off the markets as I see it. For me, it doesn't matter whether it's trading or you call it investing or whatever, but it's a certain philosophy that I've adapted, or adopted. And for me, that's the joy of doing it. Is I have full control over my time. I can basically do things however like. If I want to take off a few days, I can, and I don't have to worry about, okay, not making any money, because the markets are going to do what the markets are going to do. It will go up, it will go down. If it's in a bull run, yeah, I'll be making money while I'm sleeping or traveling or whatever, So, right. Yeah, this was more, I guess, the sort of lifestyle that I was after. Yeah. And that's why I tend to focus that way. Yeah. But yeah, roughly 15 years trading experience. And then to your question, I've been profitable maybe about 5 years, 2 years as a private trader, and then 3 years ago was when I went full time. Basically, I stopped taking management consulting assignments and gigs working with clients, and moved into doing this as my daytime job, I guess you can say.
Right. Yeah. I'm sure some people might be wondering. So, okay, so you're doing this full time, but you're not a day trader. You are someone who's taken longer and longer time frames. Sometimes years into account. How are you getting paid to pay your bills?
Yeah. I guess when I first started, that was one of my fears there, because I knew my thing was longer time horizons, and so I made sure that I had enough money to. It was like when I started my business, I was really afraid that I wouldn't be able to make it work, and so my wife, she just asked me, okay, but what would you need to be comfortable in order to make that sort of decision? And I thought, okay, enough money to cover at least 2 years of our expenses. Mm-hmm. It may be overkill for a lot of people. That's just me. That's what I needed personally. And so, yeah, I had more than enough money in the company to survive, let's say 5 years, 10 years if I needed to. So that is basically how I'm able to fund, let's say, the first, yeah, actually, I haven't taken out anything from the portfolio yet because I still have plenty of money, left over. And also in the meantime, I've had a lot of the angel investments that I made. They've sold, and they brought in capital. And then I'm invested in other businesses, that bring in a bit of cash flow as well. So it's been enough to pay the bills. But then I think maybe in 6 months to roughly a year, I'm probably going to have to bleed out of some of the portfolio holdings, to start taking a salary.
Right. Okay. So people get an idea of what your trading style is. Could you describe what you're looking for and like how's it work? Because there's people who are in and out of the market, like you start with day trading. There's scalpers. There's people trading the 1 minute chart. There's people trading the 5 minute chart. There's people taking swing trades and waiting a few weeks or maybe a couple months. So how are you trading?
Yeah. Funny thing is, like, I have an obsessive personality. So when I first started trading, one of the things that I got addicted to was trying to catch a bottom, buy at the bottom, sell at the very, very top. And as I tried to do that in these shorter time horizons, day trading, swing trading, and even, let's say, some of these monthly fluctuations, I realized that there was always a bottom that I didn't catch because it happened, before I got in. So I had to, in order to satisfy my need to catch a bottom, I had to go to longer and longer time horizons. And so I guess you could say I'm a secular type of investor. I'll get in at the beginning of a secular trend. I can trade the shorter cycles, between that. But it's not where I want to be. I prefer to get in when no one is interested in that specific asset, because then I can buy at rock bottom prices. And, buying for pennies on the dollar, like 5%, 10% of the fair value of whatever asset it is. The drawback, of course, is I have to wait for a while until, the market recognizes that. But what I've gotten better at is my timing. So that waiting period has been shorter and shorter. Just in the beginning, I was just trying to get in at the cheapest prices possible. But now I'm still getting in at bottom, maybe not rock bottom, because the earlier you get in, of course, the longer you have to wait before it starts to go into profit and starts trending. But now I've gotten a bit better in, let's say, timing it before a breakout. It could still be a few weeks, couple months, before a breakout. But it seemed I need that sort of time to build up a position. And so I'll basically build up a position over weeks, months, something like that. And then add to that position whenever the market gives me a dip or whatever. And then I'll hang on for however long it could be. So if I knew back in 2009 when I first started what I know now, the way I would have done it is I would have waited for this huge bear market that we got following the financial crisis, that we got. So the markets, the equity indexes, they bottomed in 2009. Gold and silver at the time were in a very strong bull trend, especially gold. And so back then, if I was trading back then, I would have bled out of some gold positions and started buying Apple stock, Microsoft stock, when it was selling at, like Apple was selling at 25 cents a share, which is ridiculous compared to it's up over 200 now. But that is roughly where I would have bought it, would have hung on to it, Sorry, this was back in 2001. In 2009, it was selling at $3 a share. So I would have bought it at $3 a share, and then rode it all the way up to 200 where it is now.
So people are going to be like, okay, that sounds fantastic. Most people say, don't try to catch the bottom, don't try to catch the top. It's impossible.
Mm-hmm.
How are you doing it? Like, how are you able to spot something that is going to be taking off? Because I know, and maybe you can run us through some of the calls. You called out silver, uranium, which are going up. How like what's your process? How are you doing it?
Yeah. It's basically the I guess I would call it a philosophy that I have. And the philosophy is that money needs to flow. It's in constant motion. It's flowing from one place to another. We're all doing transactions everywhere because we all got to eat. We got to pay our bills, And so businesses are constantly transacting. People need to get paid. So that is a motivator for capital to flow. And when I look at, let's say, the broad spectrum of assets, I basically divide them up into 4 different asset classes. You have your equities, which are very much in sync with the economy. You have your bond markets, which are in sync with rates, interest rates, and movements. You have your commodities markets as well, which are also in sync with interest rates and inflation. And then you have the real estate market as well, which is in sync with the economy and rates here. So if you think of these 4 different asset classes, there are other asset classes as well, but these are the 4 big ones that I look at. Basically, the capital needs to flow between them. And depending on the market conditions, the economic conditions, what's happening in the world, investors will favor one over another. And so you will have capital flow out of one asset class into another asset class at in certain periods of time. And that is when you catch a bottom or a top, basically. It's when you have these tectonic shifts, as I would call them. We are in one right now, I would say. Actually, it started a few years ago, but if you want, I can describe it to you.
Yeah.
Yeah. So the silver trade that I called out on baby pips, basically, I saw this coming back in 2021. Silver had already bottomed in 2020, and silver is very much attached to the precious metal space. And going back, gold bottomed at the end of 2015, beginning of 2016. So gold has already been in a 10-year, nearly a 10-year bull run. Silver bottomed in 2020, right after the COVID crash that we had. So prices bounced off of $12, and then spiked up, during that summer run up. But here's what I saw there at the time. When you look at the interest rates, what was happening in the bond markets, and with COVID, let's say, bringing everything to a standstill, there were no taxes coming in. The government deficits went through the roof because they had to finance an entire economy. Basically, they were sending checks to people, and stuff like this. So there was plenty of fiscal stimulation. And what happened was real rates just went negative. Real rates are basically your interest rates, whatever the banks charge you or the Federal Reserve Central Bank set as your interest rate policy, minus inflation. So basically, inflation is higher than real rates. What that means for people like you and me, normal people, is that when you look at the credit market, you're going to have winners and losers. When you have negative interest rates, it's the lenders that get hit because you're lending out, let's say, $100. You're going to get back $100, maybe a bit more, but inflation has, deteriorated the purchasing power of what you got back.
Yep.
So whatever you get back buys a whole lot less than what you lent out.
Yep.
And so negative interest rates basically represses the lenders. So at that time when these deficits exploded, we were in negative interest rates. What sort of environment does well? Which asset class does well in negative interest rates? It's hard assets, commodities. Okay, so that is when the commodities secular bull market started.
Why not, for example, real estate? Because real estate is also a hard asset, right?
Yeah, real estate is very much dependent on on interest rates.
Mm.
And it's dependent on credit, the credit markets, lending.
Mm.
So as I told you, when you have negative real rates, you basically get a credit crunch because no one wants to lend you any money.
Right.
And real estate is very much depending on mortgages, the
Right.
bank's willingness to lend you money.
Right.
So yeah, they're not going to lend you any money. And if you can't get mortgage credit to flow in the real estate sector, basically that's when real estate prices go down.
Mm.
So it's very much driven by credit conditions.
Right. And
So,
commodities is not.
No, it isn't. These are hard assets that have a certain value, specifically gold. Gold reacts to the loss of purchasing power.
Right.
So if you look at what gold and silver did in 2020, when they spiked out of they were the first to launch out of that COVID crash. And then silver ran up from $12 all the way up to $30 within months. The mining stocks went 5x, the silver mining stocks. And so that was when I realized, okay, what we had with the COVID crash was quite significant. There was a tectonic shift that had happened there. And then when you looked at all of the numbers, how much debt the US was accumulating, how much debt the European economy, so European governments were accumulating because of COVID and because of the lockdowns, how much debt people were taking on in their households and so on. So the debt burdens went up everywhere. And now we're at a point where the tax receipts, for example, that governments are getting in, and we're talking specifically about the US government, can't cover the cost of interest payments.
Mm.
And so when you had those, here was the dilemma the Fed ran into. When we had the negative real rates, that caused a commodity spike. Okay, the commodity spike, that's where your inflation comes from. Just it comes a year later.
Mm.
So a year later, after COVID, that was when we got, you remember, the inflation kicked in. And so the Fed had to raise rates all of a sudden. So what happened was first they shocked the hell out of the lenders, the bondholders, when everything went to negative real rates during the COVID crash. And then they hit them from the other side when they raised rates, because you don't want to be in a what do you call it, long on bonds when rates are going up, when they went into their aggressive rate hike cycle. So they hit them from the other side as well. And so it totally, what do you call it, hit the bond markets with the hammer and the anvil from both sides over that 2-year period. And that's why you're seeing all of these countries wanting to go more to gold and away from U.S. treasuries as these central banks, the global central banks. They would rather have in their reserve assets gold rather than treasuries, because treasuries got hit from both sides, when during this period here.
Right.
Yeah. And so when we look at that, then the debt burdens that the U.S. has to take on, and what we see now is they're no longer able to cover the costs of the debts that they have with the taxes that they're collecting. Mathematically, there's only one way out, and that way out is to devalue the dollar, or devalue all fiat currencies, the euro, the British pound, all of them. It's why we saw the Japanese yen collapse during the Japanese yen carry trade unwind. But what this means is this is the environment for commodities, because now we're seeing a loss in purchasing power. It's the only way that that is, let's say, politically acceptable for politicians in Western countries to relieve the debt burden, take the pressure off the debt burden, without, for example, canceling Social Security benefits.
Right.
You can't go and tell people, okay, we're not going to pay you your pension payments, and expect to get reelected.
Right.
Yeah.
Right. So people listening to this, they're going to have a few questions. One of them is going to be like, well, That sounds good, but I mean that's a really long time horizon. Am I not going to make more money if I were to simply trade more frequently? You know, so I have my edge, I apply that edge over and over again, I take my trades. Am I not going to be better off just doing that rather than trying to take such a long perspective on things?
Yeah. This was one of the reasons why I started getting into longer and longer time horizons. So usually when someone, let's say a trader, recognizes a hot market, it's already been going up a while. When I've gotten into, let's say, uranium back in 2021, the uranium price of uranium was about, it bottomed at about $18 a pound. I caught it between, say, $22 to $28 a pound. I started getting into some uranium names at the time, but it was literally going sideways at the time. And these uranium companies were cheap as hell. I mean, I got them for like, half of what they were worth, a third of what they were worth. And it took a while for them to get going. But once they did, by the time we reached, 2022, 2023, when the uranium bull started taking off, I was already up 300, 400% on my positions that I had there. And that was the time when traders first started realizing, okay, uranium's a hot market. Everybody wants to get into uranium mines. Which one do I want to get into? And so I already have, let's say, quite a bit of a head start, if I would explain it that way. Sure, it took me a while, to from the time I first got in, I was in the red, down maybe 10, 20% on certain positions, 30% maybe in a couple of positions. But once you get it going, you make it back quite quickly, and then it starts to compound. So if, for example, I bought something at $10 and it swings 1% a day or 5% a day, yeah, you're making 1 to 5 cents, in terms of share price per day.
Right.
But once it grows 3, 4, 5, 10x, all of a sudden you got a 10 times leverage.
Right.
What you have there. So we have this saying, in trading: cut your losses short, let your profits run.
Mm-hmm.
This is me essentially letting it run to extremes, or as far as let's say, what my personality will allow.
Right.
And so that's essentially what I am doing. And I would say that if you were to compare my results over 5 years versus, let's say, someone trading in and out, doing day trading or short-term trading, I would say over 5 years, it wouldn't make much of a difference. If they were to, let's say, be profitable their very first year, maybe I might be down because I'm waiting for my positions to come out of a long-term bottom. Mm-hmm. But because I caught the right assets, these are going to be the biggest trending assets, the hot markets. And, when everybody wants to get in, when there's a mania, I'm going to be the one selling and dumping my positions.
Right.
But over that time horizon, let's say 5 years, 10 years, I could very well, be up 4, 5, 6, 700% on the portfolio, after a few years, which is something comparable to what good day traders or whoever would right. need to be doing as well. Right. Just like I said, my equity curve would look more like this, where it goes parabolic towards the end, just like the way an asset moves versus, let's say, a very profitable day trader or short-term trader who has a more linear sort of increase in.
So how much are you, like, if someone wants to do something like that, like like how much are you risking on a position? So let's say you have a portfolio of or an account of 100,000 or whatever. Yeah. How much are you allocating for these kind of trades? Are you risking a small amount on the trade? Are you risking 10% on the trade? Because I know a guy, I forgot what his name is, but he's like a bit like a Warren Buffett. He's some Indian guy. Maybe his name is Patel. I'm not sure, but he risks 10%. Per his whatever he has scouted out. So he
Yeah.
risks a large amount on that. He takes a lot. Doesn't take many bets, but he takes a large bet on what he thinks is going to do really well, and he has done really well. So how does that look for you?
Yeah, what do you call it? One of my weaknesses, I would say, is stock picking, or let's say picking a very specific asset. My edge is in identifying the sector that's going to be hot. So it could be oil and gas. It could be, in this case now, it's precious metals, gold and silver that are hot. Uranium is also heating up again. Lithium is going to heat up here soon. But what I'm not as good at is, let's say, picking out the best names. And we can go into why I go into stocks rather than the actual commodity itself. But so what I have to do is sort of spread my bets a bit more. So if I see, for example, that there are going to be 3 really hot sectors, I'll try and assess which one I think is going to be the hottest, split off the portfolio to say, okay, that one I'll allocate 40% to, allocate 40% to the second hottest, what I think will be the second hottest, and then 20% to what I think will be the third hottest. And then from there, I realize that I can probably crack a maximum of 40 positions in the portfolio. So I try to basically build up 40 positions in the best names that I can find. And they will stay in the portfolio until I find a hotter name, or until we reach the end of the trend and it's time for me to sell and rotate into something.
Okay, so you allocate 40% of the portfolio into that specific sector, and then you spread out the risk into 40 positions, and then you
it would be 40 positions over the entire portfolio.
Oh, the entire portfolio. Okay.
Yeah, because then it becomes a bit too much to watch.
Right.
Yeah. So, for example, 40% put into precious metals. All right, so 40% of 40 positions is 16 positions. So 16 positions would go into precious metals. 16 positions into uranium. And then maybe the remaining 8 into oil and gas, or platinum, or whichever one other one I think is going to be.
So you foreshadow another question I have, which is like, okay, so you're seeing commodities going, doing well, but you're buying companies. Why you're not buying silver or uranium or whatever contracts you can get your hand on for that? Why are you going the other way?
Natural leverage. I call it natural leverage. As you may or may not know, I don't know if the audience knows this here, but when you look at a stock or invest in a stock, the major thing that sets off let's say, we look at, let's say, one of the most valuable metrics that you have is earnings in a stock. And earnings come from your profit margins. Okay? A commodities business is a very, very simple business. You basically have a production cost for, let's say we take silver, for example. Silver is a great example. Take a company that has a all-in production cost to produce 1 ounce of silver for $20. Okay? So when the price of silver is below $20, that company is essentially making a loss. They're losing $1 for every ounce that they mine. Whereas if the price then moves up to $20, then they are at break even. Okay. And now if price moves up to, let's say, just for simplicity's sake, $22. So they make $2 on every ounce of silver that they make, 10% profit margin. Okay. So we now have 10% profit margin. That business, that mining company, will get a certain valuation based on that 10% profit margin. Now let's say the price moves from $22 to $24. So now they're making $4 per ounce here now. Their profit margins have doubled.
Right.
And so here's the interesting thing. if we go a bit further and go from, let's say, $22 to, let's say, I don't know, let's say $32, we go up
Mhm.
$10, okay? Or let's say $30. I think $30 is a great example. So we go from $20 to $30 in terms of the silver price, the actual silver price. And this company basically has an all-in production cost of $20. So that $10 that they make, they now have a 50% profit margin. Okay. What happened with silver? Silver went from 20 to 30. It went up 33%. The value of the company went up 50%.
Right.
Because of their profit margins.
Right.
And so because we take profit margins into account, these commodity-based companies, stocks, have a leverage on the actual commodity.
Right. Yeah, that makes sense.
But you don't need to finance it.
Right.
The way
right.
you do, for example, if you're trading Forex and you want to take a bigger position size. You know?
Right.
Yeah.
Yeah, you have to pay the fees and everything, right?
Exactly.
Yeah. Yeah. So I'm assuming that even though you spread your risk, across 16 companies or something like that, your portfolio is still doing better, because I'm assuming you have some losers in there as well.
Yeah.
Your portfolio overall is still doing better doing it this way than just getting silver.
Yeah. Oh,
right.
Yeah. I mean, silver, when I got into it, was at 22. I got in between $20 and $22, somewhere like that, back between 2021 and 2022, during that period where it was consolidating, basically. After the first initial run up, it was consolidating. And I got into a lot of these names at very, very cheap prices because they were basically on standby. They weren't out there digging for silver because, the commodity price was too low. The price of silver was too low. They weren't going to make any money. So basically, the mines are shut down and they're on standby. And so you're able to get them at very, very cheap prices. And then when it turned around and started, let's say, the bull market in silver, went from $22 to, where's it at now? $34.50 something, $34.60, where it's at now. That is roughly what was that 14 out of 20? Yeah, 60, 70% gain or something like that. Some of the names that I have are up 300, 400%.
Right. Yeah, that makes it very clear that even the ones that don't do so well, overall, you're going to do really well.
Yes.
Doing it that way. Yeah. Right. That's very smart. Then the other question people are probably going to have around this is like, well, okay, so if I'm trading, most companies and banks and whatever, they're trading the big movements, So I'm not necessarily, unless you're doing high frequency trading, whatever, they're probably not going to do what most day traders are doing. But they might be doing what you're doing. So you're up against the big competition, right? That is the kind of perception that I have, and probably other people will have as well. And you mentioned that is not the case. So I would like you to give us a little bit more info on that.
Yeah. There might be, let's say, certain hedge funds that do what I do. And now we're talking about people like Stanley Druckenmiller or whatever that maybe take a long-term view on this. But when we look at the majority of institutional investing, financial institutions that invest other people's money, because that's literally what we are talking about when we say the big money. It's these institutions. So many of them, these are not really traders like you and me. They're financial analysts. They do trade, for these companies here, but they're employees. And they have their quarterly numbers they need to make because that's what their investors demand. You don't want to put your money into a certain fund or whatever and then see results after a year or 2 years later. As an investor, they usually set demands. They want to see quarterly results. They want to see, they want to be in the hottest trends or whatever they are. So these institutions are often under pressure to be in the best names possible at the time, whatever's trending.
Right.
Because that's what otherwise they can't attract any capital. So their focus is usually on making quarterly numbers or making numbers for the year.
Mm.
At most, it depends on the size of the institution, how much money they're moving, because if you're a whale, it takes time for you to get into a position.
Yeah.
Otherwise, you're gonna push the price way too high for you. You're just going to end up hurting yourself.
Right. Right.
So if you're very, very large and you're moving a lot of capital, okay, you have to have a longer time horizon.
Right.
But you have to balance that still with what your investors want,
Yeah.
which is quarterly results or whatever. And so they tend to take a much, much shorter focus. And if they were to, for example, go into uranium miners back in 2020, 2021, their investors say, "What the hell you're doing? You're supposed to be in Apple. You're supposed to be in Tesla. You're supposed to be in,
Right.
Netflix, because that's what's hot. You're supposed to be in Nvidia. What the hell are you thinking? Give me my money back."
Right.
So,
yeah, that makes sense. So you have an edge there because you can have a larger time horizon than these companies and not have to report quarterly gains
exactly.
on your position. The other thing that comes to my mind when I'm listening to this is like, okay, well, that sounds great, but how the bloody hell am I going to test it? So I'm trading. I can find my edge, my strategy, whatever. I can back test it. I can forward test it. There is enough cycles that I can see how it plays out, get more feel to it. This I'm like, how am I going to test it? How am I going to know that what I got is actually working? Because I'm going to be years forward testing.
Yeah.
And not realize whether it's actually a valid system or not.
Yeah. And I wouldn't say it's much of a system, what I trade, because it's more of a philosophy, based around my personality. I don't think there are many people that can do it. I was lucky enough to find some mentors, that have helped me do this here. But that, I would say, it was the hardest part for me. It was my very first year when I went full time and I started building up these positions in the uranium market, silver market, lithium market. And during that time when it's in the red, my wife is asking me, "Okay, so how's the business going?" I was saying, "Well, okay, yeah, the portfolio is down 20%, 25%." And she's like, "Okay, maybe you ought to think about changing the way you're doing things." And I'm having to explain to her that no, we're in the right names. I know I got good value, but then I had no idea when it was going to recover. But here's the beauty of, let's say, the system that I run, which is once it gets going and you are well into profit. I mean, I'm having a huge year this year. The portfolio I showed you is up 80%. And it's a 7-figure portfolio. So I'm doing very, very well. But once the positions get going, you have so much in unrealized gains that the what do you call it, emotional level, I mean, your anxiety or whatever, it's non-existent. You can suffer these sort of, let's say, pullbacks of 20-30% without it barely touching your portfolio, because if that market's not hot, another one is going to be, it's going up instead. And so what I can say is you have to have, at least I did, take a bit of what you would call a leap of faith, that what you're doing is going to work out.
Right.
And then when it really gets going, you are so much into profit that your doubts basically go away. You're not under pressure to look for that next trade, because you already know you're in a massive run here now. Yeah. All you're doing is just hanging on and trying to squeeze as much as you can. Mm-hmm. So what it's allowed me to do, and I would say the edge it's given me, is I don't need to focus on the positions that I'm in. I can focus 2-3 steps ahead of what's coming. And that was basically how I was able to make the silver call on baby pips. Right. Because from studying previous trends, I knew there were certain things that needed to happen. Yeah. And so what we were reaching was what I would call probably the first parabolic phase, or the first part of the parabolic phase, that we're going to see silver massively outperform something else. And the timing of that was even better than I expected when I put out the post. I put out the post in the morning here in Europe, and then in the afternoon you had already like broken out, and I think shot up like 7% on the day or something. Yeah.
Right.
But the thing was, what allowed me to do that was the fact that I got in so early.
Yeah.
And now I don't need to even look at my positions. I just let them run.
Yeah.
And I can focus on what the next steps are, where I think the exits are going to be,
Yeah.
where I would rotate capital into. Let's say once I do exit, I need to put it into something else, what that will look like, and so on and so on and so on. So I'm able to stay several steps ahead of the market. And that's really how I do things. I position myself before the big whales, the big money, the big traders or the institutions catch on.
Right.
So I try and get ahead of that capital flow.
Right. So someone's like, okay, this all sounds really fantastic. It's a skill set. How the hell do I train it? Like, what do I need to do to train myself to be able to spot these kind of movements? Is it even possible? Because some people are going to be like, this stuff is just dependent on the geopolitical stuff that's going on presidential elections, on interest rates, on what the Fed is going to do and other central banks are going to be doing, whether we're going to have another COVID thing or whatever. Like, is it even possible to foresee this much into the future that this happens? Like, how do I train myself to be able to do that?
Yeah, the way I look at it is, as I was telling you, like before the video here, we all have a certain lens we view the markets through. I view the markets through cycles. These long-term secular cycles, your yearly cycles, your monthly cycles, your weekly cycles, intermediate cycles, daily cycles. It's all fractal, just like we look at time frames, on our monthly charts, weekly charts, daily charts, and so on. So I see them as cycles, and I use moving averages, to show me what these different cycles are doing. When you zoom out and you look at the largest cycles that you can find, and what I am trading is actually what I would call these major economic cycles, basically between the booms and the busts. So, for example, we can go back to the dot-com bubble. That was the boom. You had the dot-com crash, which was the bust. The next cycle was between the dot-com bubble to the peak of the right before the financial crisis kicked in, when we had the subprime bubble that blew up. So that was, let's say, one part of the cycle. Then you had the financial crisis that crashed everything. That was the next part of the cycle. So this is the way I view these longest term cycles. And then you can zoom into these smaller movements. And so those long-term or secular term, as I would say, is when I get in. But I would say it's not for the faint of heart. I mean, you have to completely shift your mentality and how you think. Imagine, you're buying assets, when you're buying after the dot-com crash. Okay, you're looking to get into Google, you're looking to get into Microsoft and whatever. At a time when all your friends and everyone else around you is like, they don't want to even hear any IT names because they just lost their shirt, in the dot-com crash, But you have to ignore all of that and focus on the actual, value, the assets that are happening, because you can see that the Fed has done certain things, to try and get the economy back on track. And it's only going to be a matter of time before we recover, because everything moves in cycles. Everything will move in a cycle. The money flows in different directions depending on what phase of the cycle we're in. So my job is just to simply recognize what the cycle is, where the capital will flow to, understand the sector, and then try to find the best names in the sector. So very much, let's say, broad top-down sort of approach until you pick out, let's say, a specific sector and so on.
So how have you trained yourself, or how would you train someone to recognize these kind of cycles?
It's actually much simpler than people think. You can see cycles in many different ways. Elliott waves, for example, are a form of a cycle. Three, what do you call it? 3 impulse waves, 2, 5 waves up, I guess you would say, 3 waves, in a correction wave. That's one cycle, and then the next cycle, and so on. There are different versions of this. Some use just time cycles, just strictly on time. What I use is a modified version of what is known as Bressert cycles. It's by a guy named Walter Bressert. I don't know if you've ever heard of him. I'll recommend a book to you. He'd written these books, let's say in the early 2000s, I would say 90s, 2000s. And they're not even in digital print, they're scanned and stuff. And the way he does it is he counts the bars, let's say the number of candles from trough to trough, let's say a bottom to a bottom. And he takes statistics across, let's say, many cycles, just to see what the average count is. From a bottom to a top, from a top to a bottom, and from a bottom to a bottom. And then by looking at these statistics, you can project statistically how long it would take from a bottom to a top in a bull market, or from a top to a bottom, let's say, in a bear market. And you can set out, let's say, a target zone for where statistically the price will bottom.
Right.
Okay. And you can do this on basically any time frame. It works much more accurately on the higher time frames because you have a whole lot less noise from the HFTs and the intraday liquidity that can push price back and forth and add noise to the signals. But that is how I do it. And the simplest way to even see a cycle is just use a moving average. The moving averages that I use are the most lagging moving averages you can think of. So, for example, let's take what you were trading, the way you explained it to me. You trade the look for optimal entries once or twice a month. That is what I would refer to as a daily cycle. I would take a 10-day moving average. Simple moving average, doesn't need to be exponential or weighted or whatever. And then I even make it even more delayed, lagged by smoothing it out with another 5 periods. Essentially, it's more like a 15-day moving average now. But it's a 10-period moving average with the 5-period smoothing parameter. And so it goes very, very slowly. And I don't trade that cycle, but it tells me when the top of a cycle happened. When that moving average turns down, it confirms that was a cycle top, a daily cycle top. When it bottoms and turns up, it confirms that the trough there was a daily cycle bottom. So this is the way I look at it. I know other guys, for example, who will use just trend channels, parallel channels. I do that. I think they work fantastic.
Yeah, I use them as well.
So you zoom out, let's say, on monthly charts or quarterly charts. Here's where most people go wrong. When you look at it, trend lines, trend channels, they look so easy to draw, and they look very subjective, because that's what people ask. Okay, how do I draw this? Because it can be subjective to anyone. Actually, they're not. If you go and read a study in these technical analysis books of, let's say, I can send you some names here. Like there was one called Technical Analysis of Stocks or something like that. I'll get the name for you, and you can put it in the comments. But it will tell you how to draw objective trend lines, how to draw objective parallel channels. That will give you, I would say within 99%, I haven't seen them fail yet in terms of, let's say, telling you when you've had a major trend change.
Right. Okay. Go ahead.
Yeah. And I was going to say that there's so many ways you can measure. So you can have a cycle that, let's say you have a parallel channel. Once that parallel channel gets broken, okay, that's the end of that cycle. And then I do this on multiple time frames, multiple time horizons, to judge basically where we are at
Right.
in this cycle versus the overall larger cycle.
Right. So basically, people would have to learn to recognize cycles through they have to learn to read the charts. They have to learn to draw channels. They have to, learn how to read the moving averages and all that. Some people are going to be like, well, the moving averages, especially if it's this kind of slow, you're not going to be able to catch the bottom because it's lagging.
Yeah.
Right. So the bottom is in. You're going to see it. That was the bottom, but you're basically not able to catch it. I assume that is correct, and you're just going to get in later. You're not going to get in at the total bottom, or how is that for you?
Well, where you get in, I mean, that's more up to how much risk a person is willing to take. But what I've noticed is that when you trade these longer term, let's say cycle changes, you have months to get in,
right?
Because what we're talking about when we're talking about these cycle shifts or tectonic shifts is a change in capital flow. If we, let's say, try to connect what we see on the charts to what's happening in real life, okay, it's capital flow. We're seeing capital move out of one asset into another. And now we're talking billions, trillions of dollars. It takes time for that to happen. And so you literally have months at a bottom. When you hear traders talk about, okay, we only see a market trend, a certain amount of time, then it'll consolidate, go into a range. That range on a long-term scale, that's your distribution and accumulation phase. Right. If you, think about your Dow theory, And so it will give you literally months to get in, at least for me. I know some people that the time horizon that I trade is too long, but they will still look at those cycles and they will trade the next level down. And they will get in and out of those cycles, instead.
Right.
But you have to basically develop your own set of tools. But it really is an analysis skills, in looking at the charts and understanding what's actually happening, there.
Right.
And that takes time to develop. And I would say that the key for me was I had to stop focus on trading. I had to stop focusing on systems. Because when I focus on systems or trading, entering, exiting, I kept thinking about, okay, just wanting to make money. Okay, this indicator doesn't work. It's not accurate enough. Let's look for something else. And so when I stopped trading, I started looking at, okay, what are the markets actually doing? When do they change? What causes the change? What's driving, the change? And then I was able to relate that back into what's happening in real life. Okay, bond markets are saying that we're having a recession coming. Okay, they're going to shift out of your risk assets, your equities, and position into bonds instead, because they foresee the Fed going through a rate cutting cycle. And so whatever bonds they get into now will be much more valuable at the end of that rate cycle. You see what I'm getting at? It's that whole sort of thought process of understanding what's going on. And once you see that, okay, here's an interesting thing. Let's take the AI boom that we're seeing right now, the AI mania. There is only so much capital that can flow into the AI space before that capital becomes unproductive. It's like scaling a business. There's only so much money you can throw at it before it becomes wasted capital. You reach the point of diminishing returns. And that's usually when we start to see the end of a mania. So you've had so much capital flowing into semiconductors, for example, NVIDIA and so on. NVIDIA still has potential left, but you can see the other companies. It doesn't matter if you throw more money